This is Daybreak Asia. We're counting down to the start of trade for Japan today. Korea already offline. And Heidi, that's really the sort of theme for the trading session today. Most markets, or a lot of markets in the region, on break for the Lunar New Year holiday. But we're still keeping a track, of course, of the ones that are open and trading.
Yeah, it could just be a little bit more volatility, lower volumes, not much of a lead, but we are seeing sort of some bright spots right across the region. In fact, Japanese equities are trading pretty well at the moment.
Yeah, that's right. We saw the Nikkei actually advancing. That's the Nikkei 225 rising by the most in more than 3 months in the session yesterday. So hitting a fresh 24-year high for that benchmark. And the Nikkei, we know, of course, up around 10% over the course of this year so far alone, adding to those gains as well from the last. But we did have the yen weakening this morning in the session. Again, you're continuing to see it here, trading back again a bit closer to that 150 mark, but above that 149 threshold. What else we're tracking so far, again, as we said, that Nikkei 225 continuing to extend its advance from the session yesterday. We did have dovish comments coming through from the BOJ deputy governor, and that really, as I said, led to that yen weakness. It helped the exporters, and we saw the likes of Toyota, for instance, continuing to gain. One of the stocks we're tracking as well in the session so far today will be SoftBank. SoftBank is not trading at this point in time. Just taking a look at that bid-ask spread, and we're seeing that it's actually unmatched by quite a significant amount there. But what we are seeing for SoftBank is it's swinging back to profit in the latest reporting period. We saw it taking a lot of gains from ARM, that US chip designer that was listed last year. We also had that focus on just the general value of the portfolio companies in its vision funds, and that gained as well. So more positive signals. So certainly one to be tracking, as I said, that bid-ask spread not matching just yet, Heidi.
Take a look at how we're sort of trading as one of the few markets that are going to stay online in the coming days, and that's here in Australia. Pretty muted session, about 0.1% to the upside, but really not much conviction either way. We are seeing real estate, healthcare and technology sort of a little bit stronger than the rest of the pack, about 0.5% stronger. We are seeing the weakness, though, very pronounced when it comes to energy, down by close to 1% there as well. And this, as we continue to see that kind of split between the rise in oil prices versus what we're seeing across energy stocks necessarily. We're seeing Australian and New Zealand bonds really kind of following what we saw with US Treasuries overnight, with that pretty healthy, robust 30-year auction there. Treasuries selling off for that second day, the higher yield supporting the dollar, but the Aussie dollar holding pretty steady. We did hear from Michelle Bullock, the RBA governor, speaking to a parliamentary panel earlier on Friday morning, saying that Australia's CPI doesn't need to be in the target range in order for the RBA to cut rates. So that's that 2 to 3% inflation target band, but they could consider policy easing before it hits that point. And that's all a bit of a move when it comes to certainly the move in the dollar in the early part of the session as well. We're watching oil a little bit, crude rising. These doubts over the ceasefire have been spurring some algorithmic buying there when it comes to that part. But as I mentioned, energy stocks, so not finding that at all. Taking a look at Treasuries, we are seeing sort of more of a coherent move across the shorter end, if you will. Take a look at that 30-year, the bond sale finding buyers, really kind of some pretty good refunding, pretty good demand, and potentially soothing some of those investor nerves about demand on the long end, Belle.
Yeah, and Heidi, as you said, we are approaching that Lunar New Year break across much of the region. So this is taking a look at some of those market closures today. Mainland China, Taiwan, Hong Kong to note as well. It's partial trading today. We'll have the morning session, but not the one in the PM. Same sort of situation in Singapore, but other markets that are likewise already closed for the extended break. But I do want to get more on this now, bring in Daniel Lam. He's head of equity strategy at Standard Chartered Wealth Management, here this morning in the Hong Kong studio. And we did actually see the CSI 300 advancing over the past few sessions. So we were sort of, I'm not going to say optimistic heading into the close for the Lunar New Year break, but I'm curious what you made about the moves, because it was up about 6% or thereabouts, the best week we've seen since the reopening as well. Do you see that lasting when we get out of the Chinese New Year period?
Well, on the balance of things, probably not, okay? I believe that investors would be fading into that rally. So you see that the magnitude of the moves are getting smaller and smaller, even though it's going up. So, our view is that you do need to solve the demand side of the equation right, in order to see a structural improvement in Chinese equities overall, whether they're A shares or the Hang Seng Index.
So, I mean, those solutions are just not easy. You know, it's a multi-year process.
Yes.
When do you expect to see any sort of sentiment shift? Would it even be this year, do you think?
It's hard to say. I think it does take time for people to, return to have more confidence in Chinese assets again. So right now, I believe that, the state is, encouraging the local asset managers to be, buying up the Chinese equities. So that can put a floor to the Chinese equities, for the short term. But the floor is different from going up. That's two different things. In order to have more sustained momentum, you do need to see the structural improvement. Plus the fact that the other markets are looking pretty good, some of them, right? So it's all competing for the international fund flow. And investors, they do see a clearer pictures in some of the other markets.
Daniel, what looks good to you then in terms of some of these other options?
Well, after the earnings season, you do see that a number of the sub-industries in the US tech side are still looking pretty good. Okay, so for example, the AI side is semicon, and the cloud side, they're all looking fine. The EV side is kind of on the weaker side because the earnings has not been as good as what people thought. And also, of course, you do have the geopolitical element coming in, right? If Trump gets the presidency and investors are starting to price in that, that could be a detriment to EV side. The other markets in Asia, India, of course, is still expensive, but the budget has been pretty supportive, so probably some more upside there. Japan and Korea now, these are corporate governance stories, right? Korea with the value up program that can kind of narrow the Korean discount if it works out right. So those are quite exciting stories.
Let me ask you a bit more about Japan, though. We see, renewed highs being hit by the Nikkei. Not much has changed when it comes to the narrative, right? It was interesting. We spoke to someone else earlier in this hour, and they were saying that they're not actually in a rush because, in a lot of ways, a lot of these sort of, governance and reform promises haven't been delivered yet.
Yeah, it will take time. I mean, the Japanese equities have been low price to book for a long, long time, just like, the Korean equities. So it's a multi-year process. And so far what we're seeing is that investors are willing to give them the benefit of the doubt. I mean, obviously the speed of the upside is getting slower, okay? The excitement came last year, but now is the kind of time when they start to really put these reforms into play. And certain sectors, they do have the macro tailwind as well, right? So semiconductor sector, the car sector, enjoying the macro benefit, right, of the semiconductor cycle and also the wider mix of vehicles that are on sale. So those are looking pretty good in Japan.
Where else looks really good and has continued to for quite a period now is US stocks. Even though we're seeing it really just being led, that rally, very quite narrow breadth there. Does that concern you at all? And have you changed your allocation strategy?
Well, a little bit more concern, okay, because of the frothy level in the U.S. equities right now. But we're still overweight. Okay, we're just fine-tuning the exposure, right? Like I said, in the tech side, differentiate amongst the tech side. Within the tech, right? And also, if you want to take a barbell approach, the healthcare stocks, a number of them are doing pretty well in the US as well, right? And they always display very steady earnings. So what we are advising clients to do is that you take some excess profit in US tech and rotating them back into, say, the healthcare sector, or you put it onto the sub-industries within the techs that are still looking pretty good, like that.
All right, thanks for your time and Happy New Year as well to you.
Thank you.
That's Daniel Lamb there, Head of Equity Strategy at Standard Chartered Wealth Management. And just taking a look, as we said, about just under 10 minutes into the session so far, luxury stocks are one of the names that's standing out to us this morning because we did have L'Oreal reporting earnings yesterday, and those numbers coming in a bit better than what had been expected here. So optimistic case around the outlook for that sort of consumer segment, the discretionary spending here. Shiseido, to note, is going to be reporting earnings, so something to track. Keeping on that earnings theme, because there are a number of ones that are reporting from Japan today. You've got Tokyo Electron, Recruit, KT Corp, just some of the names that we're watching quite closely here. Tokyo Electron, one to note as well, any sort of indication we get on the demand recovery, and our Bloomberg intelligence team saying that they could actually post higher sales as well, really looking to recover possibly on chip tools. So one of the names we're tracking in particular there. SoftBank to note, it is one of the firms we're continuing to watch for it to start to trade, but as we said at the top of the hour, that bid-ask spread not matching quite yet, but we are looking, Heidi, for some pretty good gains when SoftBank does come online.
Still ahead, Bao Shinhan CEO Jin Ok-dong talks to us about the government's plan to address the so-called career discount and boosting their shareholder returns. Our exclusive interview is next. This is Bloomberg.
Watching Daybreak Asia, and we said going into that ad break there that we would be watching for trading of SoftBank, and it's actually just come online this morning, and we're seeing a pretty big spike for the company so far, really adding to the gains that we've seen across the course of this week. But right now trading up around 9%. ADRs in Wall Street soared as much as 18% in the price session, so we'll track to see if we get further gains here. But at the headline level, so we had SoftBank reporting its earnings. That third quarter net income beat estimates, and that was helped in part by its investment in T-Mobile. The company as well really focusing on how it's going to reposition its strategy around AI, and the focus when it comes to AI is its chip-making unit ARM Holdings that listed, and we had its earnings early this week. Also, that was to note in those numbers, Paytm, SoftBank sold a majority of its stake in that company before shares plunged. So again, that was something that helped it. But we have been seeing SoftBank really gaining, as I said, not just over the course of this week, but up about 25% over the course of this year. So SoftBank, as I said, one to track there. But let's shift now to what else we're tracking this morning, and that's Treasury Secretary Janet Yellen, because she says U.S. regulators are monitoring risks stemming from non-bank mortgage lenders. They've become a major presence in the mortgage market, but they rely on riskier short-term funding instruments for their operations, and they also can't access emergency Fed funds. Yellen told the Senate Banking Committee that the Financial Stability Oversight Council is paying attention.
FSOC is very focused on that because non-bank mortgage companies lack access to to deposits which banks have. There is concern that in stressful market conditions, we could see the failure of one of these.
Well, South Korea's Shinhan Financial says it has reinforced its buffers against a roughly $1 billion exposure to risky U.S. property bets. In his first interview since becoming CEO last year, Jin Ok-dong told us exclusively that the lender can stay resilient amid a wave of credit concerns in real estate.
Our overall exposure to U.S. real estate is about 2.4 trillion won, and I think the risky tranche amounts to about 1.4 trillion won. For the 1.45 trillion, we've built up about 20 billion won in provisions, and for the 1.4 trillion tranche, we've built up about 20 billion won in provisions. I'm thinking that's probably going to be managed within that.
Jin also told us that Shinhan is considering cancelling some of its own shares in addition to buybacks to boost shareholder returns. He says the government is taking a page out of Japan's playbook to tackle the so-called career discount.
Korea has a lot of industries that are quite globally leading, but the valuation of stocks in them is also low. So the government is very concerned about that. In Japan last year, they implemented a value program, and it was very effective. We saw a lot of money going into Japan, and we think the authorities are actually coming around to this now. We're trying to analyze why the Korea discount is so severe. I think that if the shareholder return policy is established well, we can repeat what Japan has done, and I think that Japan actually has a very good mix of policies. First of all, the shareholder return policy was implemented, and then the share buyback along with the share cancellation. Then the government increased the amount of taxation on personal investment among so-called NISA. The combination of these things has resulted in a lot of enrichment investment funds through share buybacks and the new pro-NISA policy. That became a plus, and it's attracted resources from other markets such as Southeast Asia. So I have hope that if those things are combined together, Korea could witness the kind of market Japan saw. It should.
Do you know when it's going to start? Do you have any information when the program begins?
The government says they're going to announce the program probably in the middle of this February. So there's a lot of anticipation about what's going to be in there. I think some of the things that are being talked about in newspapers is to create a prime index, bundling blue chips, low PBR products, and then putting that into an ETF. I think that could be a huge catalyst.
Do you think your stock is undervalued? And if you think it's undervalued by how much?
It's true that we are very undervalued right now because our PBR is around 0.41. It's hard to put a number on it, but I think the PBR should go up to a point where it's recognized by the market. It's hard to put a number on it, though.
I need to ask you now about your plans on boosting shareholder value. What plans do you have to give back money to investors?
Our strategy is to continue to increase our total return to shareholders a little bit from 2023 onwards. We did a share buyback every quarter, and if you look at our total shareholder return, including the share buyback, it was about 36%. So this year, we're going to continue our commitment to our shareholders that we made last year, that we're going to continue to buy back shares and cancel shares every quarter regardless of how the economy does. If we can do that, our goal for this year is, I don't know if we're going to achieve it this year or not, we're aiming to clear 40% first.
Why buybacks and not dividends?
In order to restore the share price resiliency, we need to reduce the share float. First of all, we need to continue the treasury stock cancellation so that we can take back some of the outstanding shares. Then we can boost the share price and the ROE will increase, increasing our shareholder value. Our first target is reducing the share float to below 500 million and to about 450 million shares. That's about 20% cancellation of stocks from the current level. It would take several years, but that's a plan. Regulators are taking a stance that they would not be involved in a big way with shareholder returns as long as there is sufficient capital. I don't think our plan would be hard as the Value Up program is coming up. The mood is favorable.
That was the Shinhan CEO, Jin Ok-dong, speaking exclusively to our markets co-anchor, David Ingles, in Seoul. And I want to draw your attention to some movers in the session so far, just about 20 minutes into trading in Tokyo today. And we are getting some big moves here. You've got SoftBank. You're seeing that extending those gains up nearly 12% at this point in time. We saw it returning to profit in the latest quarter and really helped by its focus on ARM. That's the UK chip designer that it listed in the US last year and also has been really gaining substantially after its results earlier this week. And so SoftBank, that focus on ARM, that shift or repositioning its strategy around AI is something that investors are really liking. Nissan, to the flip side here, we are seeing that one plunging the most since May of 2021. The third quarter profit numbers, they actually missed estimates. And that's important when you consider as well, we had those better numbers from Toyota this week. But Nissan, what some analysts, including those at Citi, are highlighting is that operating profit is deteriorating significantly in North America in particular, and they're saying that sales could recover, but the sustainability of any sort of recovery for the company is going to be really, really crucial. So Nissan, they're dropping after its third quarter net profit miss. Nitori Holdings, one to note as well, that's a furniture retailer, but it's at a 52-week high, and it did have those better than expected numbers. And you can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Bloomberg subscribers can go to DayBgo on their terminals. It's also available on mobile in the Bloomberg Anywhere app. You can customize your settings so you can only get the news on the industries and the assets that you care about. This is Bloomberg.
I view the markets as fundamentally broken. Like the number
fundamentally broken. That's a big statement.
Yeah, there's value is just not a consideration for most investment money that's out there. There's all the machine money and algorithmic money, which doesn't have an opinion about value. It has an opinion about price. Like, what is the price going to be in 15 minutes? And I want to be ahead of that.
Greenlight Capital founder David Einhorn, they're speaking with they're on Bloomberg's Masters in Business podcast. This is a picture across US futures, pretty mixed to downside, right? Really, we did see kind of potentially a repeat of what we saw in the previous cash session. Wall Street struggling to gain traction there. We're seeing broadly S&P futures, NASDAQ futures looking pretty flat at the moment. Dow a little bit to the downside, and the Russell 2000 futures looking really flat at this point. We had the bond market digesting yet another big sale of treasuries, and stocks have been, hovering near records, but really we've seen that prevailing narrative across global markets still really surrounding that recalibration of expectations around the Fed, and we are seeing in particular the bond market, despite the major auctions this week, struggling to find direction. We're seeing that as the case for equities too. Well, Richmond Fed President Tom Barkin says policymakers have time to be patient about rate cuts, pointing to a strong labour market and continued disinflation. He told us exclusively that he's looking at data around this time of the year with a cautious approach.
I think the data has been remarkable, and it's been remarkable across the board. Yeah, the fourth quarter GDP, 3.3%, the jobs numbers last month. And I think all of them do talk about an economy that's fundamentally healthy. That's a great thing. I am always cautious about numbers around the turn of the year. I mean, there are big seasonal adjustments. A great example would be the jobs numbers last month. The actual jobs were actually down 2.5 million because a lot of the retail folks who were hired for Christmas, then got laid off after. But the seasonal adjustments bring it up to a positive 353. So that's a pretty big seasonal adjustment. I look hard at it. I'm glad to see it coming in. That's the best data we have. But I'm not sure I'm going to take too much out of any one month.
Markets are obviously interested in if and when the Fed is going to cut, emphasis on the when. And I know you've said we don't have to be in any rush, but with the data like this, basically, are you telling people, we're doing fine with rates where they are?
Well, I have said you don't have to be in any particular hurry. You've got a dual mandate with employment and inflation. And the employment side of the mandate, I mean, it's actually operating at historic levels, 3.7% unemployment, job gains we talked about, initial claims, job openings. It's a very strong labor market still. And so gratified to see inflation coming down, hoping it continues to come down. And I think we've got some time to be patient.
I know you said you don't have a roadmap for rate cuts. Yesterday, Carlyle Group Chief Executive Harvey Schwartz said investors should not be thinking the Fed would cut rates 5 times this year because that would imply something's wrong with the economy. I assume you would agree with him.
Well, it's hard for me to get into the market forecast because there's always 2 elements going on in those forecasts. One is rate normalization under a healthy economy and inflation coming down. But the other, of course, is the economy takes a wrong turn and you'd come down faster. And so those things are a weighted average. To me, there is certainly a model that you take rates down quickly. That's not a model that's good for the economy. That's just one of the things that could happen. And then there's the model where you toggle rates down as the economy comes back into balance.
Well, how do you make a judgment then on when you think it'll be appropriate to cut? What are you looking for? The phrase I think the chairman and others have used is measurable progress toward the 2% target. How would you define that?
If I could get these kind of numbers sustained and even better broadened, that's what I'm looking for, sustained and broadening.
Take a look at SoftBank. Of course, we're tracking that reaction after what was really, a big surge a day after, again, soaring to their highest finish in 2.5 years. We are seeing upside of almost 11% at this point. And so much of this has really been bolstered by that continued upward climb in the crown jewel ARM holdings. SoftBank holding about 90% of the chip designer. And it also reported a return to profits in the December quarter after what has really been a languishing period for SoftBank and the Vision Fund. The stock was up 11% on Thursday. We're seeing another gain of almost 11% at this point. And we are kind of potentially seeing a little bit of a turnaround in its fortunes, particularly on the back of the pursuit of AI-related investments from Masa, of course. Let's bring in Amir Anvazadeh, who's a Japan equity strategist at Asymmetric Advisors. So, Amir, what stood out to you for SoftBank at the moment? And do you think this, return to positivity is warranted?
Well, it's warranted because, one is that they had a big windfall from the T-Mobile extra shares that were given based on the agreed numbers that if the share price stays above a certain level, they will get a bonus share. That was about $1.8 billion that they received. And obviously, as you pointed out, ARM, since its listing, certainly up until last quarter, was up over 40% since its listing in September. And of course, over the last day or two, we've seen the share price up another 50%, taking its valuations to a bargain basement level of 98 times earnings, which is insane. I'd rather have Nvidia, which is trading at 35 times forward earnings. But, ARM, there was only 10% of ARM's shares are floated right now. So everyone's clamoring for for some exposure certainly among the tech funds. And you can see why they've only, listed such a small amount to get that inflated valuations and then go ahead and borrow money against that 90% stake that they're still holding. That's how Son operates. So, yeah, obviously the Japanese brokers, being Son's cheerleaders, would be very excited about that. Is it sustainable? Well, it all depends very much on ARM and how much more the valuations can get re-rated. To be sure, the earnings were good, not spectacular by any means, but their V9 core architecture, has been adopted at a much higher rate, so they're seeing the royalties coming through. And obviously the smartphone market is recovering, as TSMC was telling us only a month and a half ago. The difference is that TSMC is trading at 14 times forward earnings, while even Nvidia is trading at 35 times forward earnings, and TSMC owns production of the AI chips. So that valuation differential, we think, is quite notable, and why we love TSMC here. And the fact is that the shares are not trading in right now because of the holidays in China, but in the US, certainly the share price is beginning to come close to its all-time high of 140. If it breaks that, then we see blue skies territory, and we see the share price doubling from here in a very, very short space of time. So that's the one that we're actually interested in regards to AI. But SoftBank is sentiment driven, and right now it's right in the heart of what people want to get exposed to.
Sentiment driven, so that also suggests that, now is a key point for Masa, right? How much of this hinges in terms of, how well they continue to do is how quickly they deploy cash, if they deploy cash, given how quickly AI valuations are already rising at the moment. How much focus will be there? Will there be on these net new investments, but particularly given, how picky management tend to be when it comes to that portfolio?
Yeah, I mean, look, as far as their investment record is concerned, I mean, they're terrible. They're terrible investors. They've had some massive gains, one from Alibaba, which now they're kind of looking to reinvest. They're out of Alibaba, pretty much most of it, and they're now looking to invest in other stuff. But this ARM Holdings, which was, an IoT play not long ago, has kind of fallen into the AI segment by chance. And it's pretty much dictated by that. I really can't see Son picking another big winner in the AI segment, given that everyone is so focused on AI. In fact, all its other investments in AI, I mean, he's been going on about AI, to be fair to him, for 2 years now. And looks like all his other investments have been duds. So the only one that's actually doing well was not supposed to be an AI investment, which is ARM, which is it's kind of pushing itself in that space, and it's doing well. But is it doing that well to be worth, I don't know, 100 times earnings? We don't think so, but who knows? The markets don't look at valuations these days, so we don't want to get too excited one way or another.
Amir, I'm curious as well, because you're talking about AI there, is there anything else in the Vision Fund that you're looking at as a potential catalyst for the next sort of expansion for the company? The IPO pipeline, is there anything that's standing out to you there when it comes to that AI focus?
Yeah, ByteDance stands out. The owners of TikTok, I mean, that really stands out as another big one which they've invested in with Alibaba at a very early stage. Will ByteDance be listed soon? We don't know, or whether TikTok will be listed. I mean, obviously TikTok has been coming into focus in America negatively because of issues, geopolitical issues, as well as other issues, health issues, children being exposed to poor content and so forth. But yeah, I mean, ByteDance is the big one, right? Given that they're dominating social media, that could be another big, big windfall coming from the listing of that one. Otherwise, all the investments that they've made in AI has been highly unimpressive, to be honest. I mean, you could have completely missed the dartboard if you tried. But yeah, I mean, as I said, by pure luck, AI, ARM has fallen into the AI category as one of the key players. And they bought ARM, if you go back 6-7 years ago, they bought ARM because they wanted ARM to get involved in, Internet of Things, which they've completely abandoned since then. But yeah, it's Son tends to get very, very lucky pretty much all the time. So yeah, I mean, they've dragged themselves out of that big hole, a few years back, when WeWork and other stuff were blowing up. And yeah, they're fine. And the big surprise for me was actually they didn't buy back shares, which actually shows that Goto-san, who's now in charge of, I mean, he's been in charge of the financials, but, he's now pretty much in charge of what's going on. He's really been very disciplined. Sorry.
I was going to ask you about the share buyback. I'm curious, do you think when the lockup expiry or lockup period expires in March, do you think they would use that as an opportunity at that point?
Why would that be? I mean, why would there be a connection between the share
sell
buyback
off some of their
and
shares to then raise capital from that? Do you think?
Well, I mean, they've already raised capital from ARM, not just from the selling the 10% stake, but remember that they borrow money against the value of the stake and the value of the stake has doubled, so they can always borrow money. They don't have to wait for the lockup period, which even for the lockup period to end or not end is not significant for SoftBank, which owns 90% of the company anyway. I think it'll be more significant for others whether they want to sell, after the listing. But yeah, I mean, overall, I was surprised. I mean, I think the buyback will come at some stage, and maybe not straight after the earnings, but because the share price is going up anyway. So Son only cares about the share price. And so, yeah, I think he'll keep some powder dry, waiting for a good timing to do a buyback, just to show that, he's back in charge and, everything is hunky-dory again. So, yeah, we expect a buyback at some stage. But for now, when the share price is going up 10% today, I don't think they need to, they don't need to worry about that at this stage.
Yeah, something does remove that need. Well, Amir and Vazadeh, thank you very much for your time this morning. That was Japan equity strategist at Asymmetric Advisors there. And just checking again on what we're seeing for SoftBank so far, it is that continued surge in the session, up nearly 12% at this time. But, of course, we did see ADRs really jumping more than that on Wall Street, so we'll continue tracking it. Nissan, that drop there, the most we've seen back going to 2021. We had that third quarter profit that missed estimates. Notori Holdings, that's a furniture retailer that we're tracking, better than expected numbers coming out there. And then Nexon as well to note, its first quarter operating income forecast missed estimates. So you are seeing that big drop there. So it's really just a very mixed moves that we're seeing so far, 40 minutes into the session for Tokyo. But you can watch us live and see our past interviews on our interactive TV function, TV Go. There you can also dive into any of the securities or Bloomberg functions we talk about, plus become part of the conversation by sending us instant messages during our shows. This is for Bloomberg subscribers only. Check it out at TV Go. China has snapped into crisis mode to support its tumbling markets ahead of the Lunar New Year break. It's taken aim at short sellers and freed up cash for banks. State funds have boosted stock purchases, and on Wednesday, the government surprised investors when it abruptly ousted its chief markets regulator, Yi Hu-man. Those efforts have evoked memories from 2015 when Beijing took drastic steps to stem a crash. But this time, investors say the old playbook won't be enough to fix the long-term health of China's economy. Let's discuss with our Bloomberg opinion columnist, Shuli Ren. And yeah, we've seen the national team really stepping in at points in the past to try and lift sentiment. It didn't really seem to last.
Yeah, it seems like the Chinese investors, they don't buy the national team concept anymore. I mean, this time the rally starts from the small stocks, and the smaller companies, they are just more vulnerable to economic downturns and to soaring borrowing costs. So like the government could say, okay, it is all the technicals, the quant funds, the hedge funds, the short sellers, but really fundamental investors are saying, well, it is the fundamentals of these companies. So in that sense, the stabilization fund can perhaps temporarily boost sentiment if the sentiment is coming from bad technicals. But if the fundamentals are bad, I mean, it just doesn't seem like it's going to work very well.
So then what's
Julie, so what do they need to do? I mean,
go, Heidi.
I was thinking about, there's been so much focus on what they can do for monetary easing, for fiscal easing, right? But the problem is not the demand side necessarily. Do they need more market restructuring, market reforms to be able to actually entice investors back in?
I think the so-called market reforms that they're doing are actually going to deter investors from going in, trying to ban short selling, which is a very healthy function of the market, right? And trying to investigate quant funds, or bringing the hedge fund managers for talk at the police station. These are not very helpful measures in terms of the long-term health of the China's stock market.
But how much do you think as well, surely, Xi Jinping is concerned about the stock market moves. I'm curious because we are hearing more about people on social media that are starting to really vent their frustrations in different ways. So at what point do you think it crosses the threshold where they actually have to care about it more than they do, even though it doesn't account for maybe that much of household wealth?
Yeah, like estimated 15-20% of Chinese household hold stocks. So Xi Jinping personally probably thinks it's a bunch of people who are wealthier, who are speculative, right? But if truth to be told, before the Chinese New Year, we Chinese people are very superstitious. You know, we're going to the Year of Dragon, and then with the stock market route like this, right? Like the sentiment is not very good, and then like even business people who are not affected by the stock market so much, they will be like, okay, you know, there is this wealth effect, and my business will not be so good. I probably wouldn't invest for the future, and I will probably lay off some workers. So at some point, he has to be quite concerned. I think at this point, he just probably wants to make sure the market doesn't go for free fall, but rather just fairly stabilization, and then like perhaps moving on a range bound.
Even that auspicious dragon year may not be able to help too much, right? Shuli Ren, who's our Bloomberg opinion columnist there. Take a look at some of the political headlines we're tracking around the world, and Chinese President Xi Jinping has told Russia's Vladimir Putin that they need to work together to oppose foreign interference. In a phone call, the two leaders also said they would promote joint energy projects despite sanctions led by the US. Relations between Xi and Putin have grown in the nearly 2 years that Russia launched its invasion of Ukraine. The US Supreme Court appears poised to keep Donald Trump on this year's presidential election ballots. Both Liberal and Conservative justices have questioned whether the Colorado Supreme Court has the power to exclude him on the grounds of insurrection over his alleged role in the January 6 Capitol riot. Trump is seeking a broad ruling that would end the push to kick him off ballots in several states. Well, sticking to politics, and Indonesians head to the polls next week, choosing a new president and government to lead the country for the next 5 years. Investors will be watching closely for signs of policy continuity or change ahead in Southeast Asia's largest economy. Bloomberg's chief international correspondent for Southeast Asia, Haslinda Aman, has more on what's at stake.
Campaigning has been intense in Indonesia to win the support of more than 200 million voters spread over a vast archipelago with 17,000 islands. It's a three-way fight for the top job. Leading opinion polls is Prabowo Subianto, a military general turned defense minister who's accused of human rights violations. Prabowo ran against outgoing President Joko Widodo in the 2 previous elections and lost both times. Now the two are teaming up. Prabowo's vice presidential candidate is Jokowi's eldest son, prompting criticism among people who see the pairing as an attempt to create a political dynasty, rekindling Indonesia's past. Ganjar Pranowo, the former governor of Central Java, was once supported by Jokowi, but they have since fallen out. He has the backing of the largest coalition partner, the PDIP, or Indonesian Democratic Party of Struggle, which incidentally is also Jokowi's party. And finally, Anies Baswedan, an academic who became the governor of Jakarta. He's been the most critical of Jokowi's policies, and his running mate has strong ties with the largest Muslim organization. This is a consequential election with a lot at stake. During his 2 terms in office, Jokowi helped to propel Indonesia onto the global stage, establishing stronger ties with both the US and China.
We think that there will be very important implications to the region. Like Pak Jokowi has pushed for like mineral downstream investments. A lot of investments have been coming in from China, from South Korea, from the US, from Europe. So it could have some of the implications on the regional economy, who and whether Indonesia will continue with the policies of President Jokowi's administration.
At home, he spent billions of dollars funding infrastructure projects and green lighting policies, such as moving the capital from Jakarta to Nusantara and expanding the high-speed rail, prompting debt concerns. Indonesia aims to become the fourth largest economy in the world by 2045. Whether it gets there or not may depend on how this government shapes its policies and priorities to drive growth. Haslinda Amin, Bloomberg News.
Now to Pakistan's election, where the widely expected result of a return to power for three-time Premier Nawaz Sharif is looking less certain. More than 12 hours after polls closed, results have been announced for only a few of the 265 National Assembly seats. Our Pakistan Bureau Chief Fasi Manji joins us from Karachi. And Fasi, I'm interested, I know you've been awake now for nearly 24 hours waiting for these results. What have we seen so far, and why is there such a significant delay?
Yes, thank you for having me. Yes, the reason for the delay is being cited. The Election Commission has not been coming out with the results. So there is some issue with the election counting officials. They have mentioned internet problems. Just to recall, Pakistan had switched off mobile services for security issues when the voting started. That was more than 24 hours ago. It's been 13 hours. And just as you mentioned, a handful of results have come out. But we have seen counting of multiple seats happen. Very, very early results are showing that it's going to be an upset. Former Prime Minister and jailed candidate Imran Khan's independent candidates are leading the election, which is an upset by opinion polls, because the opinion polls were showing that Nawaz Sharif, who came back from exile and rose in popularity, is seeing an upset. But again, as I mentioned, this is very early. Only a handful of seats have been officially announced, not even 5%. It's still too early to know if the assertions are correct, but Imran Khan's party leaders are coming out and saying that they are going to form the government.
Which, as you say, is extraordinary given what we expected from polling, right? How unprecedented would that situation be, and how much uncertainty does that inject into the formation of government if it in fact turns out to be what the results are when we finally get them?
Yeah, if you speak to fund managers, they're saying this is chaotic, it's chaos, and this will have a negative implication on the markets because there will be confusion on what's going to happen next. It won't be very straightforward. As I mentioned, these people are contesting as independent candidates. According to rules, they are supposed to join a party in 3 days or decide to be independents. So there are very big question marks that even party officials don't have answers to as to what is going to happen. So there is going to be a confusion state for a few days at least, and the markets can react negatively as we have spoken to traders, and the markets open in a few hours from now.
Our Pakistan Bureau Chief Fasi Manji there. I think you should try and get a little bit of sleep given those results are still incoming very slowly. You can turn to your Bloomberg for more on Pakistan's elections too. TLIV Go is where it's at. This is Bloomberg.
Taking a look at some of the movers in the session so far, SoftBank really standing out after its big move in ARM shares as well overnight.